Hey guys, Jeff Kamke with Wealth Energetics. In this video's training, I want to talk to you guys about why life insurance is not an investment. This is something that just starts driving me crazy. As you hear all the gurus, Dave Ramsey, I see ads on Facebook of George Camel from the Dave Ramsey show, and of course Dave Ramsey talking about this and many others, that life insurance is so bad because it's a horrible investment. You can get such a better rate of return other places. And we just had a client call this week, a husband and wife, and the husband was very knowledgeable in financial strategies. And the wife has heard us on the daily dose that my good friend Jeff Finley and I have done for coming up on 2 years now, where we do regular presentations around life insurance and wealth strategies and how life insurance can be a foundational asset that improves other things in your life, fills gaps that are missing in a lot of the traditional financial planning, and can just make your dollars more efficient, make your dollars go further, and just set you up for a more efficient financial life that can help you be more prosperous and let your dollars go further and can help with cash flow and a lot of different things. And so this gentleman, he was very knowledgeable. And the very first thing he was very, I like guys, I appreciate guys that are like this, where they're willing to ask the hard questions, they're willing to come right at you, and they don't pull punches and they just call it like they see it. And his very first question was, Jeff, please explain to me why I should put money into a life insurance policy when it is not a good rate of return and I get so much better money anywhere else. And I smiled and I said, well, you're absolutely right, sir. There is no reason you should be investing in life insurance because life insurance is not an investment. It is a savings alternative. It is a bond alternative, and it's not to be compared with an investment. And there's a real reason for that. When you have investments, there's risk, inherent risk with that. There's a risk of loss. When you have life insurance, when you have a whole life insurance where there's dividends and a cash value that is being paid into, there is not very much risk whatsoever. It is a guaranteed contract between you and the insurance carrier. And so whatever that is, you're not investing anything. It's a guaranteed growth of your money over the time that you have the contract. And so therefore, there is no risk inherent with that. Whereas with investing, there's a risk of loss, right? We are tied to the market. There's a potential for loss. We all know that going into it. And we know that about every 10 years or so, you're going to lose money. It's almost a guarantee that you're going to lose money in that world, which doesn't get talked about a whole lot. But that is one of the key things. So why would we use it, right? Well, there's several reasons that we love whole life insurance. It is a foundational asset that is, like I said, a savings alternative and a bond alternative. Tom Hegna, who is one of the industry experts on annuities and life insurance, talks about if you're going to do what, and I have a book right over here on my bookshelf, Tony Robbins' book, Money Master the Game. He interviewed about a dozen of the world's wealthiest people, Ray Dalio and Charles Schwab, and a bunch of guys that are, own multi-billion-dollar companies, many of them in the financial space. He interviewed all of them on what is the best financial strategy. Well, there's something called the 40-60 portfolio, where you have 60% in the stock market, 40% in bonds. And there's this whole idea that as the markets and interest rates are going up, or the markets are going down and interest rates are going down, that the stocks and the bonds, they're going to balance each other out. When one is up, the other one is down, and vice versa. And they average each other out, and you can get the gains in one, and you've got the stability from the other. And from the bonds, you get the gains, obviously, from the market. And there's much more predictable, stable growth out of bonds, but more upside, obviously, of the stock market. And that is like the ideal portfolio that many of those that were interviewed in Tony Robbins' book concluded that is like you're going to beat most advisors, most investors, that you just stick to that, you're going to do it. Well, Tom Hegna says, well, you know what? Instead of you investing in bonds, life insurance companies, their portfolios, their general funds are diversified, a very large allocation into bonds. And they are one of the most profitable companies in the history of America because they've been profitable. Many of them have been around for well over 100 years. Many of them have been profitable for over 140 years, meaning there's not been a year that they've lost money. So they know how to make money during unpredictable times, down markets, world wars. They were profitable during the Civil War. They were profitable during both world wars. They were profitable during the Great Depression. Imagine this, that they were profitable. So the idea is using life insurance as a bond alternative. So whatever portfolio percentage your advisor has you allocated for bonds, a good strategy could be to use that in life insurance. Let life insurance be the bond alternative. And the reason you do that is because you get the stability, the predictability in your portfolio that life insurance and the bonds provide. But then you also get, obviously, the death benefit. That death benefit is a permanent thing. It's not like Dave Ramsey where he tells you to go get term and it's so super cheap, but then, oh, maybe everything didn't go quite right with my investments and maybe everything didn't go quite right in my life. And I don't have this massive pile of money, millions of dollars that my mutual funds or my 401k have generated over my working years. And gosh darn it, I'm not self-insured like he'd want you to be. And I still need life insurance for income replacement and some of the other things that it provides. And I can't access it because now the second or third term of my term life insurance policy, it's no longer 29 bucks a month. Now it's 290 bucks a month. And maybe it went to $2,900 a month. It is amazing if you look at a term life illustration for a 10-year term, a 20-year term, it is super cheap in that first term. After that, many times it can go up by 5, 10, 15, 20 times, depending on your age and when you get started. And at some point, it becomes mathematically stupid, doesn't make sense on paper mathematically to even put your money into a term life policy because the premium is so high. And so with a life insurance that's permanent, you know that you've got coverage no matter what. If things don't go quite right, you can do what's called a reduced paid up. You remain locked in at how much ever premium you have paid that buys a certain amount of death benefit, and you have that for the rest of your life. It can never go away, and you don't have to pay into it anymore. So there's contingencies there that, you know, if life gets tricky, you have that option. And so then obviously there's a cash value though, like we talked about, that is the bond alternative, and that is guaranteed uninterrupted compounding growth and a tax-free environment. And there's dividends on top of that. So while on paper, Dave Ramsey would say, well, I can go earn 12% over here in this mutual fund. So why would I get 3, 4, 5% inside of a whole life insurance contract? Well, you know, Dave, you're not talking about apples to apples here. Your qualified money, your equities, your securities that you're talking about, that is the 401k, that is the mutual fund, that is the stock portfolio, whatever number you're talking about, that's the gross amount. That's not before taxes. So if you're making 12%, you're probably going to net 8 or 9. Okay. Well, after taxes, that's the real world scenario, right? Well, if you have money in a life insurance contract, you're getting 3, 4, 5%, something like that. There's no taxes out of it. Well, how much would you earn to come back down to 3 or 4 or 5%? Well, you're probably talking 6, 7, 8, maybe 9%, depending on your tax bracket. Probably 8, probably not 9. Okay, so we're pretty close, right? Okay, well, this is getting us a death benefit. Our 401k, it's not purchasing a death benefit. In fact, our investments make horrible insurance. Being self-insured is the most inefficient way to go about insuring because it takes $1 of your money to be insured for that same amount of coverage, right? If you have a $250,000 house, you need to be self-insured. You need $250,000 of money liquid, not tied up in some 401k that you have to pay penalties to get and all that stuff. I'm talking true self-insurance would be my house burned down today. Tomorrow I've got $250,000 to go buy a new one. That is self-insurance. Well, it takes, for every dollar you need, you have to have that same amount of money liquid. Whereas life insurance, when we're talking about your human life value, the value you are as a human being that life insurance is based on, if you're to be self-insured there, you need to have equivalent of that amount of money. But if you do the life insurance route, you're paying pennies on the dollar of coverage. So if you have a $250,000 death benefit, you know, obviously the term coverage might be, you know, 20, 30, 40, 50 bucks a month. Obviously a permanent policy, depending on how it's structured and what the purpose and strategy behind it is, you know, could be several hundred or several $1,000s per month, depending on what you're utilizing it for. And that gives you full coverage on your lifetime. You're going to have that coverage no matter what. You don't have to worry about it running out. And so that is a powerful piece because having the big nest egg isn't going to need to be also utilized to self-insure you. You can keep that for what it's made for, to grow money and to produce income in retirement. That's the whole point of having it, right? And produce financial freedom at some point, maybe even before retirement, right? So that's one of the powerful things that allows you to do. But the cash value inside of a life insurance contract can serve as some growth, more conservatively, obviously, but much more predictably. And when you do get to the income stream part of retirement, if you have some money in a cash value life insurance policy and the market goes down 30% one year, well, you don't have to withdraw out of your your mutual fund or your 401k, you could actually take the cash value. You could actually do a withdrawal on it up to what you've put into it without hitting a tax. Or you could do a policy loan. There's an interest cost to that, but it wouldn't trigger taxation because there's no taxable event on debt, right? When you're taking a policy loan where you're basically using your cash value as collateral, and the insurance company is saying, I'll give you a line of credit on that. There's that strategy as well. You can use that to get you through the downtime in the market. We use the life insurance cash value as what we call a volatility buffer to help you get through those rough times. And so that's a strategy that can come into play. And so one of the really powerful things that gets overlooked a lot, I see Dave Ramsey ads that talk about life insurance tries to do two things and is crappy at both because it's so expensive of a premium to get the death benefit, and you're trying to invest and you can get such better rate of return other places. Well, when you're looking at it just like that, he's probably somewhat accurate. However, the death benefit, having life insurance is so important because not only does it provide income replacement, it provides a legacy transfer. But here's one of the things that I don't hear hardly anybody talking about is the living benefits with a death benefit. So if you have a chronic illness or a terminal illness and you need access to cash to maybe go seek alternative treatment because the hospital you're at is trying to get you into drugs and surgery and chemo or radiation, and you don't want to go that route, you want to go try to find a holistic doctor, a functional doctor. It's going to get to the root cause of what's causing your health problem. Well, you could access a portion of your death benefit, maybe around 50% early. You'd have to have those riders built in. One of the main companies we use, it comes automatic with the policy. You would get access to your death benefit. So that's a strategy. That is a gap in a financial plan that how are you going to get that other places? There's no health insurance going to allow you to go to a functional doctor. But the life insurance is adaptable. It's flexible. It can serve multiple purposes. It can solve multiple problems, provide multiple solutions throughout somebody's entire working life. I'll have other videos on the channel, check them out, about other strategies, other gaps that life insurance fills. But this is the one I'm going to talk about right now because it's relevant to the death benefit. That is a hidden, under talked about, underutilized function of life insurance. It can be the saving grace between you being here and you not. My mentor, Chris from Life 180, his father-in-law exercised this exact strategy. He had pancreatic cancer, which is a terminal diagnosis back in 2020. He is still alive to this day and thriving because he went to seek alternative treatment. He got access to his death benefit early, and boom, he is still alive. He's still thriving. He's still playing golf 4 days a week. From what Chris tells, and he tells the story often. We were at a training down in the Dominican Republic in April. He was talking about it down there. Very, very powerful. It's something that gets overlooked is, well, I don't need life insurance because I'm self-insured. Well, the self-insurance may not even cover, your human life value or your income. Maybe not is going to do as much for you as you think. But even if it could, is it the most efficient way to go about it? The answer is no. And we'll have other videos that go into the math that really prove that point. Why it's more efficient to have pennies for dollars of coverage than it is for you trying to do it all yourself out of your investments. It's better to have your investments do what investments are supposed to do, which are grow and then produce cash flow, instead of trying to be there to be your long-term care, to be your legacy transfer, to be your death benefit if you need that. Like you're trying to do, it goes back to what I just said. Dave talks about what life insurance is. It tries to do multiple things and it's crappy at it. Well, that's where investments make horrible life insurance, because investments are trying to be your long-term care, trying to be your income. It's trying to be this, and that's not efficient either. That doesn't work either. And so we have to really look at all of this and see where, it makes sense to do this. So back to my original point here, which is life insurance is not an investment, and it absolutely is not. If you hear somebody on social media or on TikTok claiming that life insurance is an investment, you probably know the level of education that they have and understanding around the tool of life insurance might be a little elementary. They might be newer in the business, or their mentors, are maybe trying to pitch them in a way to just make sales. And they don't truly understand the mechanics of a policy and how life insurance companies work and how to use this tool as an asset throughout your life. From, could be used for college. It can be used for growing capital and access to capital for a business. It can be used as your own family bank, where you're controlling the banking function of your life. So let's just say, there's a family that has a rich uncle, right? And that rich uncle could finance the kids' cars, and he could buy the kids' houses, and maybe be some upfront capital for entrepreneur venture, something like that. Well, a lot of times we have the ability to utilize that same function inside of a whole life policy. If the cash value was big enough, you know what I mean? You're obviously enough cash flow going into it, but that could serve as a family bank. And this is the way that many families, elite wealthy families, and not even elite wealthy families, just people that understand this principle will use this as well. Is, you know, maybe the mom and the dad, they're in their 40s or 50s, they're successful, they've got plenty of money, they've done what they need to, they don't need to pay off debt, their money's growing and working for them in the way that they need to, they've got plenty of cash flow, and they want to be a blessing to their children and maybe even grandchildren. And so the amount of money that they've amassed, a portion of that is in cash value of life insurance, maybe several $100,000, maybe even several $1,000,000. And when their children need to buy a house, they don't go to a bank and need to take out a mortgage and pay higher interest rates and be at the mercy of the bank. They're actually understanding that the flow of interest when you're paying for a loan to a normal bank is an erosion of wealth for the family. And so, see, this is a perspective change that, yeah, life insurance is an investment, but it can make a profound financial change in your life, in your financial life for you and your family and future generations. Because if you understand where money gets lost, and money gets lost in a lot of places, one of the big ones is interest that you're paying on credit cards, loans for cars, your mortgage. If you could, I mean, think about this. All the interest you've ever paid on anything you've ever bought, how much would that total in your lifetime? And if you could have half of that back, how much of a difference would that make right now in your life to have an extra 25 grand or 50 grand or 100 grand? I mean, some of you have mortgages you've been paying on for 20 years. Well, that's a lot of interest costs, because a lot of times, depending on the interest rate and the length of the loan, you're paying double for a house. If you bought a $100,000 house, you're probably paying around $100,000 in interest costs when interest rates are, you know, 6, 7, 8% is usually where it starts to double. So it's significant. So if you have that ability, access to capital through the cash value of the life insurance policy, to have the control over your money. And it's funny, the wealthier the people I talk to, the more important control is for them. And the more that they resonate with this message of having the cash value in a life insurance policy where the money's growing, it's that savings alternative that I talked about, where they're getting way more interest than a savings account at a bank would give them, but they've got control. They can do what they want when they want to it. The loans to get are simple. There's no credit checks. You don't have to go fill out applications. You don't have to wait 30 days. You can get access to capital usually within 2 to maybe 4 business days, and you can do what you need to with it. It's super simple. And then in that strategy, you could put the down payment on a child's house or buy it outright. And then the child is making payments back to the life insurance policy. And that is keeping the interest cost in the family. So you'd still pay the interest cost, but it would go to the family instead of to an outside bank. And again, that, you know, thinking of how much money you've paid in interest costs over your entire lifetime, if you could have a portion of that back, how much of a difference would it make? Well, think about that generation after generation. The Rockefeller family is the 6th generation of doing this principle, where they've utilized life insurance, cash value life insurance, to be the catalyst to perpetuate wealth. Obviously, they've got other businesses that are, you know, bringing in tons of cash flow, and there's appreciation and all those things, and it's the main source of their net worth. But they're, you know, leveraging a portion in cash value life insurance that's going to the next generation. The death benefit gets transferred tax-free, and it's allowing each generation to build on the next one because of this powerful principle. So that is a great way that this can be used. So there's other things that I could get into I will in other videos, but that's just kind of the gist I wanted to touch on with this, is just understanding that life insurance is not an investment, but is a powerful tool. Caleb Williams from Better Wealth talked about it as the and asset, as the only asset or financial instrument that allows you to have flexibility and options to do this and this. Most all other financial instruments and tools are singular focused. A 401k is for retirement only. A 529 college plan is for your child's college education only. Term life insurance is only for life insurance protection, right? We see everything in these individual buckets. So when we put money into a cash value life insurance policy, we're getting the death benefit. We're gaining control over the savings or bond alternative aspect of the growth of a portfolio for our financial success long term. We're getting asset protection with that money that's in there. So we don't have to worry about if we ever got sued or bankruptcy, that money's protected. And because that money's in there, it's outside of taxation. It's out in most circumstances, as long as you don't try to withdraw more than you put in. And then for college planning, this is a key thing. I'll have videos that go into this more in depth, but for college planning, the government looks at your income and what you're filing on your tax return. So if you have cash value in a life insurance contract, that will not affect and count against you or your child for trying to go get a student loan or grants or scholarships. You can get more money for your child by having money inside of a cash value life insurance contract. And that is a strategy for better college planning. So do you see how this tool, life insurance, and I haven't even covered everything that it is, you know, where it fits into different gaps and how it serves multiple functions. And there's so many more things that I'm not even talking about in this video, but hopefully you can get an idea of, wow, this is a very powerful financial instrument that can do a lot of things. It can morph, it can flex, it can be with me for my entire lifetime and meet needs and solve problems and be solutions that I don't know what else would do that. There's no other instrument out there that does this. And this is why it's a foundational asset that we can then build a very strong financial structure on top of. So hopefully this was enlightening. Hopefully that you gain some knowledge and insight on why this is important. And if this does resonate with you and you want to set this up for you or learn more about how this would work for you, in the description with this video, please click my calendar link and you can schedule a call with me. We can go over what the strategy might look like in your life. I always want to know a little bit about your financial situation and what your goals are so that we can strategize the most, you know, pinpointed for your situation and show you some ways that utilizing a whole life policy in your financial picture can help leverage and enhance everything else you're trying to do and give you more control, more certainty over your finances and how that has a ripple effect into other areas of your life. So if that's something that interests you, make sure you click the link in the description to do that. And then also make sure you're subscribed to this YouTube channel. You've clicked the notification bell. So anytime I produce content around wealth strategies and the inner work and bioenergetics, which is they go hand in hand. You can't do one without the other. To grow and expand with money, we have to grow ourselves. We have to discard aspects of us that are not our true authentic self. They might be the things that we've taken on from other people or experiences that are weighting us down. And those are some things that I produce on this channel. So make sure you're alerted when I produce them, because it's all designed to help you take steps forward in your pursuit of abundance and the way that you live in this world abundantly. So thanks for watching, guys. And also, if you have any comments or questions, please put them in the comment section below. I personally respond to every single person that posts in here, and I love interaction. I love questions and comments, so please do that. And with that, make it a great day, and we'll talk to you guys soon. Take care.